Okay, everyone, just a quick sound check and then we can get started. Thanks for joining in. Let me know if audio is coming through okay and video is coming through okay. If everything is good, then we can get started. Okay, just before we begin, just a quick general advice and risk warning disclaimer. Note that any advice given is deemed to be of general nature, as the information or advice given does not take into account your particular objectives, financial situations, or needs. Therefore, at all times, you should consider the appropriateness of the advice before you act further. CFDs and Forex are leveraged products that carry a high level of risk and are not suitable for everyone. Someone's already asking the question, can you lose more than your initial deposit with CFDs? There's some cases, yes. So you can lose more than your initial deposit, so you should ensure CFD and Forex trading meets your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. I'll just answer that question really quickly. If you guys are new here and with anything, right, whether it's finance, whether it's life, I'll just be honest and be frank here. Can you lose your capital? Theoretically, yes. If you run a business, can you lose your business? Theoretically, yes. So yeah, with any kind of investing or trading, you could lose that capital. So make sure that, you know, that's something you set aside in terms of funding. All right, our distance is good. Everything is good. Let me know if there's any issues. If not, then we are going to proceed. So, what do you guys think of 2022 so far? Right, I've got a few things prepared, and I might even give you a preview of the upcoming webinars. Right, but what do you guys think of 2022, and what do you think is going to happen in 2023? Because I'll be honest with you, if you are a trader, if you are trading CFDs, I can share you a story. I'll like share with you a story. My biggest trade or my biggest win in terms of percentage gain is actually during the collapse in 2008, right? When the market was panicking and, you know, everyone was really concerned about the recession, which is what we call the Great Recession. That was actually when I made the most gains in terms of my trading, and up until now, I don't think we actually saw that kind of range even throughout the whole COVID seasons, right? So I would say, you know, not to worry too much, because whether the market goes up or whether the market goes down, as a CFD trader, you can actually trade whichever way the market goes, right? So I would actually see that more as a benefit. I would actually see that more as a fuel for the market to be driven in a certain direction, and it's easier to sell fear. Okay, and I don't know about you, but you guys probably heard on the media people talk about, you know, everyone's talking about what 2023 is likely going to be. It's going to be worse than 2022, blah blah blah, and so forth. I'm just gonna show you the facts to you. I'm going to give you the parameters, and then I'll show you the facts, and then you guys decide for yourself what do you think 2023 is going to be, right? Whether or not we are actually within a recession. So, my honest answer, I just don't have the fact for me to actually call the current market or whether the upcoming situation is going to be a recession. So is there going to be a huge recession in 2023? You know, I've been through that, what happened in 2008, 2011, 2012. So that was a double dip recession. That's a W recession, right? So yeah, I don't think I'm that concerned. I'm not here to tell you, you know, I'm not telling you to be afraid of it. If there's a huge sell-off in the market, then I would say, yeah, you know what, bring it on. I think that's a good move to kind of push whatever trade that you want. You can short the hell out of the market if you want to, right? But let's talk statistics, And let's talk facts, right? This is what the economic cycle is likely going to be. So we basically have a throw, an expansion, a peak, and then we have a contraction, and then the whole cycle begins again, right? We'll cover this a lot more when we are going to be doing this webinar in the future, but I'm just going to give you a quick pick on what it is, right? So for it to be in a recession, we would be looking at a market that is in a contraction. For the market to be in a contraction, there are a few things that we need to watch out for. The first thing is the GDP growth. It would have to be below 2%, all right? And this is basing on the latest recession that we had, which is the global financial crisis. So we got GDP growth below 2%, unemployment above 5% and increasing, which is already something that we don't actually have right now. Stocks as an indicator enters a bear market. We have entered the bear market pretty much we actually don't have a bear market during the 2020 pandemic. We had a bear market, a slight bear market in late 21 to 22, which we'll take a look later on, but we're not really in a huge bear market, and I'll show you the facts later on, right? Static or normal recession, which is at least 6 months in GDP contraction. Okay, which is a huge thing to us right now, because the metric for a technical recession is just 2 consecutive quarterly GDP decline, right? That's basically what the 6 months contraction in GDP looks like. This is no longer used in the US following the global financial crisis, and major economies are actually they actually stopped using this during the COVID-19 pandemic, beginning in March 2022. So they kind of abandoned this metrics, right? What I would call the Great Recession, and this is what I'm going to compare it with, is actually during the 2007-2009 subprime and global financial crisis, right? A recession is not a depression. We had a Great Depression. This is a completely different thing. So we are going to take a look at a Great Recession, a Great Depression, and then the market is now talking about a potential recession, right? I'm not even considering a Great Recession. The basic metrics for a potential recession, just keep this in mind. It's GDP growth below 2%, and the unemployment rate above 5% and increasing. Now, I'm not saying that the whole world is not going to experience recession. Some countries are going to experience this recession. Some countries in the G20, I believe, like South Africa, if we take a look at the statistics, I know some of you guys are in Africa. The unemployment rate is still really high, but we are going to compare a few things, right? I'm not going to say everyone is going to be safe, no, but I think the major economies that people talk about when we talk about recession would be, the US, the UK, the Eurozone, right? They're not in recession. I'll put it out. I'll just be frank. The UK, in terms of technical recession, yes, they have 2 consecutive quarter of GDP contraction, but that's pretty much it. The unemployment rate, it's still all right. So this is what we call the market cycle, by the way. Okay, so I'll come back to this in a minute, but I'm just going to show you, this is just one way of looking into things. The other way of looking into things would be to take a look at the bond market as well. But I know some of you guys are here probably wondering, what happened to cryptocurrency and stuff like that. I'll explain all that. Don't worry about it. All right, so let's take a look at the unemployment rate. This is amongst the G20. Again, the metric is that 5% would be the level to watch out for, right? If we have a continuing unemployment rate, an increasing unemployment rate above 5%, then that's where we need to be worried about. But if we take a look at the United States, it's 3.5%, United Kingdom 3.7%, Canada at 5%, China 5.5%. You need to be careful with this one though, because if we talk about the comparison between United States, United Kingdom, and then all of a sudden we're comparing it with Argentina, Indonesia, Brazil, India, Turkey. Some of these are developing countries, right? So they have a huge economy, but in terms of the standard of living, it would be different because there's comparison between a developed country and a developing country. It's that with the developed country, there's a lot more jobs. The unemployment rate should be lower. Okay, but this is within reasons. Okay, we'll just focus on the United States for now. because the news that the media fits you in right now in terms of the global recession, blah blah blah, that's going to be based off what's likely going to happen in the United States. Okay, so United States 3.5% unemployment rate, not really a huge concern. This is the GDP growth for the United States, right? Take a look at this one here. We have a little bit of a dip we got a little bit of a dip in July 2021. That's where it actually starts, right? So if you want to consider the whole recession thing, right, if everyone's going to tell you 2023 is going to be so bad, the whole thing has started since July 2021, right? The drop that you see in the market that everyone is experiencing right now has already happened. So it's a little bit too late to call a potential recession. We might actually have been in the recession. We might actually be at the throat right now. We might actually be coming out of it. Okay, so the pandemic, that was a huge drop in the GDP growth. There was a huge spike in the unemployment rate as well, which is I think about 14-16% in the US. But that was a different case, right? I mean, in modern history, we never experienced a global pandemic on a scale like what COVID did. So this is a unique situation. We're still learning. I think economists are likely going to come up with new theories. They're going to come up with new textbooks for future economists in, let's say, 5-10 years time. They're probably going to be looking at the COVID case, and there's probably going to be studies done on the whole COVID situation. We don't have that luxury because we're living through it, right? We are experiencing that live. So it was a little bit unique. So in terms of GDP, of course, the whole world basically comes to a halt, but we recovered. We recovered really quickly. Take a look at the, let me see if I can zoom in here. Right? So starting July 2021, we have a little bit of a dip in the GDP from 12.5% to 5% growth, right? But in terms of consecutive GDP drop, right? This is the old metric, 2 quarters, and then we call it a recession. President Biden basically says, and Janet Yellen basically kind of disregards this drop in the GDP because there's a little bit of other factors to play in. We can't just say 2 quarterly GDP and then the whole thing is in a recession, because there's other factors to look into. We got to look at the inflation numbers, we got to look at the unemployment numbers. GDP, it's one thing, but it's not really the whole picture, right? Okay, so we had that drop happen in 2022. So 2022 was a really surprising year. It was actually one of the more volatile years. I had an easier time trading 2021, but a lot of people thought, this is the feedback. I've done this webinar in other language, and the feedback that I got was, a lot of you guys in the OctaFX channel actually finds 2022 a lot easier compared to 2021. I actually find 2022 a little bit hard to navigate, but I had an easier time in 2021. Okay, so this is the United States GDP numbers. This is the unemployment numbers. You can take a look at the spike here. That's during COVID. Right, it just spiked up nearly 15%, close to 16%. It dropped down really quickly though, and then it stabilizes. So 2022 is unique. In a sense where inflation was high. The concern was with the high inflation, economic growth is going to slow down. Everything is going to cost a lot more. But the good thing is people are still employed, right? The unemployment rate was really, really low. So in terms of the whole picture, if we take a look at GDP growth, it wasn't so bad. Inflation was pretty high. But the saving grace would be that the unemployment rate was actually stable. Okay, in fact, if you take a look at the unemployment rate, comparing it to before the pandemic, we are basically at pre-pandemic level for the US. You can take a look at other countries as well. All right, we can go to United Kingdoms, the UK. By the way, this is trading economics. It's free. You guys can check it out there. And you can take a look at a comparison on the unemployment rate as well over there if you want to. Okay. So this is a very, very useful site. This is the site that I use to kind of gather information for you guys for the weekly outlook, right? But if you guys want to go there, it's called Trading Economics, and you can do a comparison on other countries if you want to. Okay. Right. So let's pause here for a minute. And what do you guys think? Do you guys think? How long have you guys been trading? If you guys are new, then we welcome. This is trading. This is going to be interesting. All right. And I think this is a great start to get this kind of information before you start your trading career. But for those that has been trading, let's say for the past year or the past 2 years, what do you guys think of, what happened in 21, 22? What do you guys think is going to happen in 23? If you can comment, then it'll be great. Okay. With that, I'll just quickly jump onto the the chart here and give you a comparison on the Euro USD. This is the Euro USD. If we take a look at the range in the Euro USD, comparing it all the way back to, let's say, 2018, 2019, on average, if you take a look at the volatility in a year, 2017, 2018, it was pretty huge, right? I mean, back in 2017, we had a year range of, 1,750 pips. And then 2018, we had 1,340. And then in 2019, it was 690 pips. During the COVID, it was 1,674. So the reason why I say it was really harder to navigate in 2022, because put 1 and 2 together, what happened in 2022, it was actually a more volatile market than when the COVID first hits, right? COVID-19 hits in 2020, the yearly range was just 1,674. That was how volatile it was. Last year it was 1,959. It was much more volatile. Obviously, there's a lot in play. 2022 we got war breaking out in Russia and Ukraine, which triggers an energy crisis, and which fuels the inflation. It's really what's pushing up the inflation. We just got a report coming out from Bank of England admitting that the inflation might drop sharply because energy prices has come off quickly as well. So we know the driving factor, at least in the Eurozone, in the UK, what's really pushing inflation in a lot of countries is just really energy prices, right? It's just basically oil prices, gas prices. That's really what's pushing the inflation number up. With the previous CPI numbers coming out from the Eurozone, this number has become more apparent because inflation has dropped off because the energy prices came off. But the core CPI, which is the inflation number excluding energy and cars, actually goes up. So food prices is actually still going up right now. Inflation is actually still there, but take away the energy prices, it does help a lot. So 2022 was a huge surprise to a lot of us. We didn't know. We kind of anticipated energy prices to go up. I didn't know what the trigger was. You guys that have been following my webinars since 2020, yeah. You guys probably, some of you guys picked up on the old trade that we did in 2021. We picked it up without even knowing, if the war is going to come, right? We just don't know what it is. So it was a little bit of a surprise. And if we take a look at some currencies like the pound USD, for example, it was a much bigger surprise, right? Because it was a 3,300 pips volatility in terms of range in 2022. That was again partly because of the fiscal policy or the mini budget coming out from the 2-week government. I don't know if you want to call that a government. It's probably the most short-lived government in history in the UK. I don't know. It was really short. It was such a mess, right? It created a fragility in confidence in the UK financial sector, right? That was back. It was just recent. It was just in October. It was just 3 months ago. So a lot of things has happened. But again, main driving factor or the main issue was inflation in 2022. We already know the inflation was picking up in 2021. We do know quantitative tightening, or the interest rate hikes coming out from the central banks around the world. And that was already planned ahead. It wasn't a surprise. It wasn't a shock to the market. But a lot of people that don't follow what's been going on the background, then yeah, it would be quite a shock. And to a lot of new traders, it will be a shock as well. But I guess it's good to experience that shock in the early stage of your trading career. At least you saw that volatility, and then you can look back and say, like, yeah, you know what, it wasn't so bad. It wasn't as bad as 2022. So my expectation for 2023, do we see more volatility in the market? We could see more volatility in the market. Do we see a recovery in the market? I don't think we're going to be seeing that recovery on the GDP growth across the globe. Do I see the economy slowing down a little bit? Yes, it needs to slow down, because without the economy slowing down, the inflation will not go away. So the inflation is a really unique piece here, because if we understand inflation here, the reason why inflation was high, and the reason why it was gaining really, really quickly, and I'll guide this to the crypto market soon, is this. So during the COVID pandemic, when it hits, the government needs to provide help. The government needs to provide support for a lot of unemployed people. A lot of industries was getting shut down. Tourism industry pretty much dead. Services industry was pretty much dead. Restaurateurs are pretty much having a hard time because there are some restrictions. People can't go out. People can't go and dine out and stuff like that. So it's changing. It's evolving. People can't go to work and stuff like that. Some of us are lucky that we can work remotely. But to a lot of people, it was a nightmare. So with that, government needs to do something. So they basically provide help by loosening the monetary policy. That means bringing down the interest rate, providing support, providing liquidity in the market just to keep the economy going on, right? Just to keep the gear moving. So that's basically what happened during the COVID pandemic, right? When it hits really big, it was actually March 2020. No one in the world would predict that the financial market was going to recover in just 3 months. If you take a look at the recovery in 2022, it was basically just a flip in like 3 months. So I'll bring you the US 30 here. All right. So you see that this area over here, this is the drop. That drop was just 3-4 months, pretty much 3 months. When it really hits, it was actually March, right? So we have some indication of slowing down basically in February, because the whole thing started in December 2019. So that was a red line, right? But if with the US 30, take a look at this one here. COVID hits, globally, people, it was spreading. The drop wasn't there. The drop doesn't happen until February, leading into March, and it dropped all the way down. Basically just in March, right? It was basically just, how many weeks is that? It was literally just 1 month. It was 1 month of drop, and then the market picked it up. So market basically recovers pretty much in 24 weeks, right? It was less than half a year. It picked up. So by August 2020, it was already at the level before it collapsed. And if I were to zoom out a little bit, and you guys take a look at where it is right now, it's way off higher than what it was, during the fall off, right? So it was huge. Well, we had that drop, and then the market recovered. So if we take a look at the drop itself was, let's take it from all the way up there. The drop was basically just about 38%, which is about 40%. By technical standard term, it's just 38.2%, Fibonacci retracement, which is a normal retracement in the market. But if we take a look at the whole recovery all the way there up until the highest point, it was 103%. in terms of recovery. So I wouldn't really call this a bear market. I would not call this a bear market. I would call this a bear market if the market was, if the market didn't recover, if the market continued to drop down. So if we don't have the current recovery here, if the market goes all the way back down, let's say to 20,000, then I would consider that a bear market, but I don't really consider this a bear market at this point in time. So yeah. So the market, no one predicted how quickly the market was going to flip. So what happened with the quantitative easing or the monetary easing is that, it provides people with cheap borrowings, right? So a lot of people do this. I don't do it, but I know a lot of people that I know did this. So they start borrowing money and they start buying houses. Housing property market was actually recovering during the COVID pandemic. People are actually moving away from the city. They buy properties, outside of the cities, and they move away. Say borrowing cost was so cheap, people just borrowed money from the bank, and instead of savings, they start spending, right? That drives up the inflation factor. And I know some people actually they started borrowing money, and they use that money to invest in other asset classes, and one of them are actually cryptocurrencies. Now, if we take a look at the whole crypto market, it wasn't fueled by anything. It wasn't fueled by fundamentals. It wasn't fueled by technicals. It cannot be fueled by fundamentals, because the whole thing with crypto market is that it was supposed to be deregulated. It was supposed to be decentralized. It wasn't supposed to be, nothing is supposed to have an impact on it. Okay, but if you take a look at the jump in 2020, take a look at when this breaks out and when the whole thing runs to the upside. The US 30 starts going back to its full normal rate around around August, right? I got around August 2020. Take a look at Bitcoin around August 2020, which is around there, right? That's around August. So around August 2020, what happened with Bitcoin is that it starts breaking and it starts running to the upside. Again, this is driven by cheap borrowing costs. A lot of people do this, right? It was driven by hype. It wasn't driven by anything fundamentals. It was driven by nothing technical, right? It was pure mess. And there's nothing behind. This is Bitcoin. Imagine what drives this up. It was all the other altcoins. It was all the other funny coins, the scam coins. I don't know what you want to call it, but that's basically what happened in 2020, 2021. A lot of people got scammed. A lot of people start buying weird little coins. They start calling it altcoins. Do they understand what's going on? I'll tell you right now, about 80% that of investors in crypto market in 2020 and 2021 don't even understand what it is, right? I can assure you right now on this chat right now, I would say maybe about 30% of you probably got it wrong. 30% of you probably think it is part of the currency market. It's not part of the currency market. Cryptocurrency, it's a separate asset class. It's a completely different thing. It's not governed by, what's really going on in terms of looking at the GDP numbers, CPI numbers. It was not supposed to be, right? So this drives it up. People were hyping it up. It was all over social media. A lot of these investors are not, well-educated traders. They're not well-educated in terms of the financial terms and stuff like that. But the story goes, a friend made a lot of money buying coins, so you should buy in, and everyone just started buying in, right? It drives it up. It drives it up really crazy. It's not at its normal level. It jumps up by a significant amount of percentage gain. I mean, if you take a look at August to all-time high, it was 572%. No market does this. It doesn't make sense. It doesn't click. But it was driven by hype, and hype works. It went viral, pretty much. It went viral. And everyone thought, I'll just buy something. And, historically, if you had a coin in, let's say, 2018, you'll be, I don't know how many, you'll be a millionaire, a billionaire, I don't know. Then people start thinking like that. But then people are doing it wrong, because every single month there's going to be some new altcoins. and everyone, by the time they got into something, they got in at the very top, right? So the hype was there. It boosted it up, right? It went down. People thought it was cheap. People buy in again, and then reality come crashing. If you take a look at the whole situation right now, the market has actually reset itself to a level before it runs up, before the whole hype thing went crazy, right? So there is no Bitcoin crash. There was an illusionary rally. There was no crash, because what the market did is basically kick off all of those people that jump in without even understanding what it is. And take a look at it. It basically resets itself. Was the driver the whole FTX stuff? It wasn't, right? Was that issue about it that continues to pressure the Bitcoins? Yes, but if you take a look at the whole FTX story, it was really weird, because why do people all of a sudden that trade cryptocurrencies? The reason why they move away from a normal currency is supposed to be deregulated, decentralized. All of a sudden they're looking for the government to start regulating it again. So it's really weird from my perspective. It's just such a weird asset. So in 2023, the world is not going to be in a recession. The world, if I were to say the whole world, probably not, because if you take a look at the facts, it just cannot happen, because the logic here is that the unemployment rate, it's pretty low. So this is the technical term of a recession, right? GDP growth below 2%. The GDP growth in the US, take a look at the whole world. In fact, this is the GDP growth, right? Argentina 10, Germany 1.9, sure, that might be below 2. Japan, yes, that has been constantly low. But if we take a look at the United Kingdom, United States, UK was actually 7.4. The US was 5.9. South Africa is at 4.9. Indonesia is at 3.69. GDP growth right now, it's slightly higher. It's around 4% projected to about 5%. So take a look at this. This would be a template, right? If you just jump in and you want to know what do you want to call a recession, by technical terms, we cannot call this, the whole situation right now, a recession, just because we don't have that GDP growth that's below 2%, that's constant around the world. The whole world is not experiencing that. The unemployment rate about 5% and increasing. We don't have that. We have unemployment rate in the US around 3%. 3.4, 3.6%, and decreasing, right? It was stable. It's not really increasing. We're just not at that level. So this is what you want, if you want to call. This is the Great Depression and the Great Recession. There are differences here. So let's take a look at the Great Depression, which is 1929 to 1939. It lasted for 43 months. Right, real GDP was negative 36.2%. This is the US, right? We're looking at the US numbers here. So real GDP negative 36.2%. The unemployment rate was at 25%. The Great Recession, which is the global financial crisis plus the subprime mortgage crisis, which I just told you at the very beginning of the session, was basically the best time of my trading career, because I shorted the hell out of the market, because I was, people are so fearful. I just use that as, I just use that to my advantage, that I can short sell the market like nobody's business, and no one is, is brave enough to buy against the market. Right? I was shorting the pound. The biggest trade that I made was shorting the pound from £2 to 1.36. That was in 2008. So the Great Recession lasted for 18 months, okay? So these are great recessions, the Great Depression, they lasted a very long period of time, 18 months, which is 1.5 years. And real GDP was negative 5.1%. The unemployment rate was at 10%. We are so far away from that, number one. Number two, if we start looking at the drop in the GDP, in the US GDP numbers, it started dropping in July 2021. So the Great Recession, which is a global financial crisis, which is categorized as a technical recession by any other methods or any other means, it was a hard time, right? it was really hard looking for jobs back then. Just to let you know, one of the few reasons why I just trade full time for a long period of time. Anyway, that aside, take a look at the GDP drop here. It was basically in July 2021. Measure how long it was. It was basically a year and a half ago. So by technical terms, we call ourselves in a recession, not a great recession. We already passed beyond the 18 months mark. So what gives? So I don't think 2023 is going to be as bad as everyone is saying. People are like saying it's doom and gloom in 2023. It's going to be worse than 2022. I don't think it's as bad as it is. We had a severe inflation issue in 2022. Interest rate hikes was going up. We're slowing down on the interest rate side. Unemployment remains stable. GDP growth, it's there. It's not going to be extreme, but it's there. So the whole thing with 2023 and the whole GDP growth or the whole economic growth with the interest rate hike, it was designed to slow down the economic growth, right? So if we go back to the economic cycle here, during 2020, instead of being in a pandemic, the market was basically in an expansion. It was actually really picking up, right? So if we take a look at peak, inflation is where it's going to be above 2%. So I'll just go through this. This is supposed to be for future webinars, but I'll just fill you guys in on this one so you guys can take a screenshot if you want to. In a market that's expanding, GDP growth at a rate of 2 to 3%. Inflation is near 2%, but it's not at 2%. Unemployment is 4.5 to 5%. Stocks as an indicator in a bullish market, right? The whole COVID-19 rally, the whole crypto rally, whatever, it was basically showing that the market was at its peak. It was actually overheating. It was so hot, right? Economic growth wasn't slowing down. It was just continuing to expand. GDP growth was all above 3%. Inflation was way above 2%. So it was actually at the peak. So if we take a look at the market, we know as expansion, it's going to be followed by a peak. The peak is going to be at the very high, and then a contraction is expected. That's basically what it is. So how do we know if we are going to get out of it, right? So we will see a throw appears because a contraction causes an increase in demand as products are cheaper, but we're not seeing that because we have an inflation issue. So we're not really on a textbook playground here right now, okay? Production output increases. We don't have a production output that increases yet. We're still having a supply issue that really is pushing up the inflation, but the employment numbers has decreased, right? So we are actually at a potential turnaround or potential pivot in the market. We could actually see this once inflation stabilizes. We could actually see production output increases, the economic growth speeds up again. But we first need to get rid of the inflation, because if the inflation is there, we're never going to get out of this recovery. So we'll actually be stuck in that contraction. So we take a look at one whole period of a contraction. It could actually last for a long period of time. So there are a few cycles here that we can use, right? There's a 10-year cycle, there's a 30-year cycle. So there's a lot of stuff that we will discuss in future webinar, but I'm just going to show you this so you have a little bit of an idea where we are in the market, because if you don't know where we are in the market, it's really going to be tough trading it, right? Okay. Right. So the other one is actually the inverted yield curve, but let me just pause for a bit and I'll go through the questions if there's any questions. What is CFD? CFD is contract for differences. You are trading based on a contract. You're not trading the real asset. You're trading a contract of the assets. So 2023 was not going to be in a recession. So I don't really like to use that word recession, because I just laid out the facts. I just give you the parameters. I just gave you the statistics. Decide for yourself what you think it's going to be in 2023. for my own personal view, I don't think, you know, economic growth is going to be crazy good, right? People are going to be looking at the year 2023 as a potential slump. It's going to be there. It's either going to go down a little bit, but I don't think it's going to be going down drastically, unless there's another variant or another virus that causes, you know, a severe halt in the market in the whole world. I don't think we are in that situation, because if we take a look at China, which has been locked down for 3 years, the borders has just opened. Japan has already opened for tourism. I was there in December. I would know because the gate was open, right? So the whole world is reopening in themselves. I think we are going to see different sectors like the tourism sectors, the services sectors are going to pick up, right? Energy sector, we have seen that pullback. The energy sector is actually really stable right now, because if you take a look at the oil market, it's pretty stable. So we have a little bit of a pullback, right? Take a look at the pullback here. You know, the whole Ukraine Russia thing slow, you know, kind of calms down a little bit. The whole world kind of acknowledges what happened. You know, it just went back to normal again. So where price is right now, it's pretty normal around 2021, you know, just roughly before the whole war thing happened, right? So we are actually at a normal rate in the market. It's actually pretty stable. So we have come off the extreme volatility. Do I expect potential volatility in the market? Yeah, I think, look, we're in 2023, and when it comes to trading, we can kind of calculate our risk to a certain degree. But with anything, there's always that 1% risk of things going bad or things going against you. So I would always take that 1% risk as a potential thing that could actually destroy you when it comes to your trading. That's just my way of looking into things, right? So yeah, honest opinion, I don't think 2023 is going to be as bad as what people are talking about right now. Again, media loves to sell fear, and because you know what, fear makes money. You'll watch that media, you'll watch something, because if I were to tell you, you know what, you need to be careful, you need to come to my webinar tomorrow, because otherwise the whole world's going to crash, and you will come and see, because you're scared of something, right? People are not going to talk, people are not going to say, oh yeah, we're in a bullish market, everything is great. If you take a look at the whole media out there, media plays on fear, and it's just simple as that. They will sell you fear because it's easy to sell or instill fear in people, right? If you take a look at the drop in a bear market, it's super easy for the market to crash, but it's harder for it to recover. If you take a look at this one here, right, it was so quick to drop, it takes a longer time to recover. And it's just the same thing. It's just the same scenario with any other crashes out there. The market, it crashes easily and a lot faster than it would recover. Because if you take a look at the whole recovery back to 2014 level, for example, on US oil, it would take them, how many years is this? 2016 to 2022. So about 6 years to pull back, right? It only take them 2 years to crash. So it's easy to sell fear, and I know why people like to sell fear, but I would advise you this. If you saw a market that's scared of something and it started crashing down, use that to your advantage. Don't be afraid of it. But yeah, buy in on the fear. Just take it in. If people are fearful, just use it to your advantage. That it's okay for the market to collapse. It's fine for the market to pull back. It's fine for the market to correct itself. Can you trade the fear? Yes, by all means, trade the fear. Hi from the Philippines. How are you? How high do you think the dollar yen will go for 2023? Is there a chance for another bubbles coming in the market? Depends on what bubbles you're talking about. Any specific bubbles, the stock bubble, the real estate bubble, the currency bubble. I don't think that's going to be a currency bubble. Housing market bubble, there might be. There's always that risk there. How far do you think with dollar yen could go for how high do you think the dollar yen would go for 2023? I would probably start thinking how far down it could go. In terms of how far up it would go, I don't think it will exceed 150. I think we have seen the peak at 150 from last year. You know, there was that intervention. If price goes back to 150, then yeah. But if you take a look at 2023, this is going to be fresh. If you're asking dollar yen, tomorrow you're going to get your answer. If they remove the yield control curve tomorrow, the dollar yen is actually going to crash because the yen is going to get a boost, and then the bond market is actually going to crash, and then you are actually going to be looking at a potential crash in the bond market as well. So, which is in line with what I'm going to show you, which is the bond market to use as a gauge for a potential recession, right? So let's take a look at the bond market for a little bit. The whole reason why the whole world right now is shouting recession is because we have an inverted yield. What is an inverted yield? So there are two things that you can take a look at. If you want to get this bond information numbers, you can use TradingView to pull it out if you want to. But let me just give you a comparison of what's going on. All right, so this is the US 10 years. I'm just going to remove it. Right, this is the US 10 years. I'll change it to line. I'm going to add the US 2 years. Okay, so this is an inverted curve. You know why? Because the 2-year yield, now the 2-year yield is basically what you get for a 2-year bond, right? The 2-year yield is at a higher yield than a 10-year yield. Therefore, if you're buying a 2-year bond, you'll actually make more money than holding a 10-year bond, which doesn't make sense because the logic is if you buy bonds and you hold it for a longer period of time, you are supposed to get a higher interest rate than a shorter bond period, right? So this is what we call the inverted curve, because the 2-year bond or the short-term bond has a higher yield than the long-term bond. And this was an indication for a potential recession, because when an inverted yield pops up, it typically is, you know, between 6 months to 12 months, you're likely going to find a recession. But the guy that comes up with this formula actually stated for the current inverted yield curve, it's actually not an indication of a potential recession, because we are in a different situation. We had a global pandemic, number one, and then we had a higher inflation number. So it was really tough because the higher inflation number leading up to a potential recession, it was actually hard to look at. If I were to say, is there a potential for a stagflation instead? So yeah, a stagnant economy and an inflation, yes, I would call that a potential for a stagflation. But this is something that a lot of people are actually looking at, the inverted yield curve. And if you want to look at the curve for different countries, you can go to worldgovernmentbonds.com, and then you can go by the country, and then you look for the yield curve. If the yield curve points to the downside, it's an inverted yield curve, because the yield curve is supposed to go up. So let's take a look at some of the countries as well. Okay. Okay, this is the UK yield curve. It's actually flat. It's actually not inverted. It was inverted, okay, and then it became flat in January 2023. So this is right now flat. The yield curve has actually stabilizes. So remember what happened with the UK market. The bond market crashes in October. So even with that, it was pretty okay. All right. So what's the story with Japan right now? So the story with Japan is this. There was actually supposed to be a yield cap of 25 basis points. This yield cap was removed, and I think I discussed this in some of the older webinars. This was discussed in December, obviously. The cap was adjusted to 50 basis points. Let me just hide my Ichimoku cloud for a little bit. So the cap was at 50 basis points. Sorry, where was the line again? right? 0.5. So theoretically, at when price touches 50 basis points, the Bank of Japan is going to start bond purchases to bring the yield down. We're not seeing that, and the Bank of Japan actually bought the largest amount of bond purchases in history at 5 trillion yen per day on last Friday. It didn't bring the yield down. So bond prices and yields are actually inverse related. So if bond prices goes up, yields are going to go down. If bond prices goes down, the yield is going to go up. So people are actually selling bonds in Japan right now. And then even with Bank of Japan buying bonds back, they can't bring the yield down. So there's no point keeping the yield control curve. And this is a concern. This is the probably the biggest risk and the biggest surprise this year at the very start of the year. This is actually going to be tomorrow. If they remove the yield control curve, it's actually going to crash the bond market. The yield tomorrow is going to go way up. Today, right now, at this very moment, right now, I think we are actually seeing this picked up just 2 hours ago. It jumped up to about 10 basis points, which is huge, which is a lot, right? So tomorrow, if Bank of Japan starts removing the yield control curve, then they might say, yeah, we are going to stop our ultra loose monetary policy easing, right? We are going to tighten it a little bit. We are going to remove the yield curve first, and then we might hike interest rate, let's say in June. Okay, so this is going to be the first step for Japan to do that, and they're late in the game because the whole world has already increased their interest rate. The whole world, the central banks around the world is actually starting to slow down their interest rate hikes, right? But Japan is probably going to start this soon with a new Bank of Japan governor starting in April, and then we might actually see that shift happen in June. But this is going to be the first step. If tomorrow they are going to remove this, it will crash the bond market. The yield's going to go up. The bond prices in Japan is going to crash. This is going to have a ripple effect around the globe. It's not just Japan that's going to experience that. The whole bond market is the whole world is going to crash. The US is going to crash. The UK is also going to crash. That's going to drive yields up higher, right? It's going to be really weird because the dollar yen might crash tomorrow, but then once everything starts crashing down, people are going to start buying into the dollar again, and then the US 10-year yield is going to go up. It's actually going to make the dollar stronger again. So this is going to be really interesting to see, right? So is there a surprise for 2023? Yeah, I think there's a lot of surprises, but it'll be interesting. And the way I look at this every year is that every year is always going to be a new learning experience for me. We can look at the past for a little bit of an information. We can look at the past for a little bit of what to look out for, that kind of thing, but it's never 100% thing, right? So yeah, back to the question. What do I think about the dollar yen? I don't think we are actually going to be looking at anything higher than 150 at this point in time for 2023, because we could potentially crash down on the dollar yen. There's a lot of room for this one to correct. This one could go all the way down to 112, which is huge, right? I believe it was 1,239 pips. And this could happen in a month. If we lose 126, it's gone. Hitan, do I think Bitcoin will ever go to its high again? Honest opinion, it's going to be tough. Will it be? Will it be there again? Yes, it will. I just don't know how long. It could be 5 years. It could be 10 years. Look, what drives it in 2020, 2021, it's pure hype. It was pure viral stuff. Can it go up again? I would say never say never, right? But we don't have the right criteria for it right now. We're just not looking at it, because if we take a look at it from a weekly perspective, it's way down below. There's a lot of resistances. For it to get all the way back up there to close to 70,000, it might take a long while unless something causes it to go viral again. So this is not driven by anything fundamentals, and probably you guys experience this. Technicals doesn't really work well, if you notice, in 2021 and 2022 for cryptos, right? Momentum doesn't click, volume set's going to be tough. Your breakout strategies might fail you because it kind of disrupts the whole thing, because 2020, 2021, we see a lot of people that don't have a clue on what's really going on in terms of price movement. They have no clue on the technical side of trading, and look, it was an abusive market. It was really painful to watch. And I basically warn people, don't really buy too much into this. Buy some, yeah, but don't invest the whole amount. You can play around if you want to. You got extra cash going around. You want to experience the hype, go for it. But to invest everything into one basket, especially the crypto market, do I get the logic behind the crypto market? Yeah, I get what it is, what it's for, what it's designed for. The one thing I can never agree to a cryptocurrency is that there's nothing backing it. All right, the fiat currency was based on a gold standard. Up until the Bretton Woods Agreement, the U.S. was basically, you can exchange the U.S. dollar for a gold if you want to. It was based on that, right? It was based on a foreign reserve. It was based on gold reserve. That's basically it. It has something. The currency has something behind it. It was backed by how strong the economy is. But with cryptocurrency, I don't know what's really backing it. So. It was basically running on I don't know what. I don't even know what it is that's behind it. So if the market is going to crash tomorrow and Bitcoin goes to $1, what are you going to do about it? Like FTX right now, what are people going to do? They just lose their money, and that's pretty much it. They can do, they can go for trials, and they can try to sue the hell out this guy, but the money's already gone. Right, that's the kind of risk that's involved that a lot of people don't understand when they start buying into the crypto market. Correct me if I'm wrong. I feel the dollar will lose more value against other major pairs 2023 because of the possible Fed actions in cutting rates if they eventually do. So I don't think we are at the stage of interest rate cuts yet. I think for 2023, I think we're still going to be in that interest rate hike phase, probably just not as high. In terms of whether or not that's going to be an indication of whether the dollar is actually going to be weaker and stuff like that, yeah. In terms of hawkishness, probably the Fed is out of the whole central banks out there. I think the Fed's probably are the one that sends the right messages out, kind of a clear message in terms of what they want to do. So it's a little bit more predictable compared to, let's say, the Bank of England, which I really hate, and I don't really trust what Bailey says. Lagarde, I'm okay with that, but in terms of the Eurozone, it's just a little bit tough because inflation is all over the place right now on the Eurozone. So is the dollar going to lose strength? Possibly, yes. In terms of a little bit of technical correction, I think we could be in for a little bit of that technical correction that has actually started all the way back in October. So we are actually in that phase right now. We might see a little bit of a pullback, but that's pretty much it. So, but yeah, we might be in that correction, but does it happen in the first 6 months? Probably not, right? It might be more of a transition phase in the first 6 months in 2023, and then if it does break, it's sustainable, then yeah, it might rally up towards the second half of the year. But the first half of the year, it's more on the Euro USD, the Pound USD, the dollar finding its footing in terms of what the underlying trend is, correcting itself, for it to be positioned for more of a sustainable trend. But right now we're not within that sustainable trend. We are a little bit exhausted. I do expect a little bit of a pullback to happen in the first half of, I wouldn't say the first half, for the first 3 months in 2023. I might see a little bit of a pause in the market right now, especially on the Euro USD or the Pound USD. We might see that pause. We might see a little bit of a correction. We might. But really depends on whether or not the bond market is going to crash. Hopefully not. Find it very difficult to set my stop loss or take profit, especially when price is very close to the top where one can see figures by the right. You mean if price it's at the top as in right now, like where it is right now? You don't. Typically, you don't counter what the trend is. You don't, for example, on this one here, you can set a take profit target level if you want to. You can use Fibonacci extensions. You can use previous key levels or previous resistance levels. But if you're new and you're looking at the current market, that you need to know whether the market is trending up, down, or moving in sideways market condition. That would be the first thing that you need to do as a trader. You need to understand this market conditions. Once you understand the market conditions, the second rule is just to never go against that trend. That's simple as that. Okay. It's not the Japanese yen that's going to impact the bond market. It's what Bank of Japan is going to do tomorrow. Currently, what's capping the bond market in Japan, or what's making the monetary policy easing, is that the Bank of Japan continues to buy bonds in Japan, right? The JGB, or the Japanese government bonds. And what's the purpose of the Japanese government bonds? Like, think about it. If Bank of Japan buys Japanese government bonds, it's basically Bank of Japan printing money for the Japanese government. As simple as that. If they stop buying the bonds because they can't continue buying bonds because they can't control the yield, which is not supposed to be above 50. It's currently above 50 basis points. It's at 60 right now, right? If they can't just continue buying bonds and not seeing results, so they will say, you know what, we will stop the bond buying purchases. They will remove the limiter on this one here. It will send the 10-year yield to the upside. It means people are actually going to get rid of the Japanese bonds, right? It's going to crash the bond markets, and then the other bond markets actually look at the Japanese market as kind of a peg. Once that limiter is removed, then there's more reason for everyone in other countries to start selling their bonds as well, because the bond market is unstable. They'll have to remove their position from the bond market and maybe move it to the currency market. But by doing so, it will crash the bond market first. It will send the dollar yen to the downside, because once the JGB yield goes way up, it will cause the Japanese yen to get stronger. We are going to discuss this in a separate webinar in the future, talking about the correlation between the bond market as well. But this is just a little bit of information. I haven't looked at the dollar yen market. I think it's pretty stable. But if we take a look at the hourly time frame, it is still within the Ishimoku cloud. So we're still waiting for a little bit of a explanation on this one. This one just spiked up about two hours ago. Get it? Good. When do you know the surge of the market price? What do you mean by the surge of the market price? When you mean when the market's going to break out or when the market's going to rally? There are a few tools you can use. You can use a simple range breakout if you want to. So maybe I can put an example on this one here. Sorry, let me get rid of this. And we can go back to our normal schedule, right? So how do we know if there's going to be a rally? For example, on the dollar yen, the level to watch out for this year in terms of resistance is going to be 150, which was the resistance or the cap from last year. This was when the Japanese government and the Bank of Japan intervened in the currency market, I think for the first time in a long time, right? I think 15 years they haven't intervened. But they intervened last year, right around October, when people were just dumping the yen. The yen was so weak; it was actually at its weakest point in a very long period of time. So you can take a look at how far it goes all the way back. Global financial crisis was here. The yen was basically around 125. The yen during the global financial crisis was basically still lower. Sorry, it's still stronger than what it is right now. So yeah. So that causes a lot of headaches, right? So do I expect the dollar yen to go all the way higher? We might if we see a little bit of a bounce, but I kind of doubt it a little bit, because if we take a look at this one here, once we transition below that 126 level, I think there's a lot of reason for this one to just traverse lower back into 2021 range, which is around 112. So does that mean in terms of volatility it's huge? Yeah, it's huge, because we are expecting a 1,200 pip drop in maybe the first month or two in 2023. I'm good. How are you, Faizan? Okay. So what else? So we did talk about the Euro USD, we talked about oil, we talked about gold. I gave you a reason behind the cryptocurrency collapse. I gave you the 2023 economic outlook. I don't think it's going to be as bad as what everyone is saying. That's what I'm trying to say. So even if it is bad, and I just told you the story at the very beginning, the biggest gain that I made was during the global financial crisis, when the market was collapsing and when everyone is so fearful, everyone's just selling everything. I was there shorting the pound USD. I was selling it from £2 to 1.36. It was 1.3680 to be specific. But yeah, it's burning into my head because I shorted the hell out of it. I scaled in a lot of times. I think about 15 or 16 positions, long-term positions that I held for months, shorting it from 2 to 1.36. But yes, if the market drops, go with the flow. Let's say with the dollar Japanese yen, if it drops tomorrow, I'm anticipating a 1,200 pips drop if the Bank of Japan removed that yield curve cap, yield control curve. So yeah, why not trade the dollar yen and sell the dollar yen? I'm buying the dollar. I'm shorting the dollar. I'm buying the Japanese yen. So you can take advantage of this information that I just gave you. If they do remove that, you know what's causing it tomorrow, because I can assure you, maybe around 80% of traders out there probably don't even know what's likely going to hit them if that happens tomorrow. But hey, at least you have that information right now. If it happens, great. We could be in for 1,200 pips right to the downside. If it doesn't happen, hey, at least you have that information, and you know Bank of Japan is likely going to keep doing that every month. Okay? Oh, thanks, man. Thanks, Faizan. Hello to Pakistan as well. All right, I think we can wrap it up for tonight. Any questions so far? Any questions that I haven't answered? I think we can do a Q&A session at this point in time. Any questions regarding things that I haven't answered? But I think, I answered quite a lot. Gave you guys a lot of indications out there. I would probably say, you know what, just screenshot this. This is going to give you a little bit of an explanation. We are going to have a webinar in the economic cycles. This is an upcoming webinar, so I'm just giving you the material right now. Some of you probably have seen this material before in other language. What's the probability that euro yen will go back to around 149? 149 on the euro yen. Probably the same situation as in the dollar yen. It's going to be a little bit tough. But does it have a better case for the euro yen to get stronger to 149 than the dollar yen? Yes. Right now, let me give you a little bit of an explanation here. So with this one here, this is choppy, right? This is super choppy right now. I'll get rid of the fibs. You guys can take a look at the euro yen right now. This is the euro yen, and I'm going to throw in the dollar yen for you right now. Take a look at the whole dynamic on the dollar yen. The dollar yen has dropped significantly more than the euro yen. So if we go by the weekly time frame, this is the dollar yen. The dollar yen is within the Ichimoku cloud. It's potentially shifting, right? The euro yen, this one here is above the Ichimoku cloud. It's still way stronger. Technically, this is still within an uptrend. So for the euro yen, does it have the possibility of returning to 149? I would say it could be. It has a higher probability than the dollar yen returning to 150. So in terms of the probability, I don't know in percentage wise, but if we take a look at the corrections and what it is right now, the whole correction right now, it's still contained within 61.8%. We are not below 78.6%. So it's tough to tell, but there are going to be some criteria. For example, price needs to maintain a position above 140. And then 141, 142, actually 140 and then 142. If they can stay above 140 and 142 within the next 2 months, then you actually have about 60% chance of looking at a potential return towards 149. Okay, but we need to get through 140, 142 first. How about Aussie yen? Same thing with the euro yen. The Aussie yen, I'll bring my Aussie yen chart here because you guys know what the Aussie yen is. We got that 92.91, right? So if we don't go back above 92.91, then we're not going to be looking at any actions. So we need to overcome 91.92 on the Aussie yen, 140, 142 on the euro yen. How can you control the market price? I don't think anyone can control the market price. Like, I'll just give you an example right now. So a lot of people say, you know what, people are manipulating the market and stuff like that. Bank of Japan just bought 5 trillion yen worth of bonds on Friday, and they're still unable to control the yield in the market. So they're still, with their intervention at 5 trillion yen in one day, they're still unable to control the yield on the bond prices, right? The bond market still crashes. So Bank of Japan, man, can't even control stuff. How would anyone else like us, like retail traders, are going to be there manipulating the market? It's going to be really tough, right? I don't think we actually have that control. When it comes to trading, I don't think it's control. We actually don't have control. I'll just be honest right now with you. If you guys think trading is all about control, we actually don't have control. What we have is control of our own risks, and that's how you actually find success in trading. It's just controlling your own risks. You control your trade. Yep, pretty much it. That's right, Chuck. Love it. Okay. Any questions so far? Nope. All good? All right, then we can wrap it up for tonight. Thanks for joining in, and hope this has been an insightful session. If you're watching this in the future, look forward to future webinars where we are going to talk about economic cycles. Okay. Thanks for joining in, guys. Good luck with your trades, and this is a little bit of a warning. If you're trading the yen crosses, be on the lookout tomorrow from the Bank of Japan. Hopefully nothing happens, but just in case if it happens, you at the very least what's the reason behind whatever triggers any movement in the market tomorrow. All right. Yeah, I can help you. Of course, we can help you. If you have any questions, just ask. But if you're new, you can start from the beginner sessions. Look for beginners webinars. That's where you get started first. If you want any hints on where to get started, I would say if you learn about what the market condition is, whether the market is trending or in sideways market condition, that's going to help you a lot. All right, guys, have a great one. It's good to have you here, and I'll see you soon.